Welcome class to module 1.1. So on this module, we're going to discuss one additional problem involving the acquisition of assets with dismantling cost. Or just like I said in the previous module, dismantling cost is same with decommissioning cost. So our learning objective for this module will be to account for the initial recognition of property, plant, and equipment involving or with decommissioning costs or estimated liability for decommissioning costs. Let's look at this example problem. ABC company purchased a new equipment and the invoice price of that equipment was 180,000. The company paid for the assets within 10 days. So it is allowed a 2% discount. So we have a 2% discount. The freight cost for delivering the equipment was 2,000 and the premium of 1,500 was paid for special insurance policy to cover the transportation of the equipment. The company spent 4,000 to install the asset and additional 500 in startup necessary to get the asset ready for regular production. The company has a constructive obligation to dismantle the asset at the end of its 3 years useful life at a cost of 30,000. So this 30,000 is the estimated cost of the dismantling cost. And the average borrowing rate of the company at the date of acquisition of the equipment is 10%. So the requirement is given or indicated in the next slide. First requirement. So what is the cost of the asset? So I told you from the previous module or the previous video presentation, the cost of an asset will include the purchase price, including import duties and non-refundable purchase taxes. For example, excise tax or custom duties. After deducting trade discounts and rebates, so discount taken or not taken should be deducted. In addition to the purchase price, cost directly attributable to bringing the asset to the location. So that will include the freight costs and insurance costs and condition necessary for it to be capable or of operating in the manner intended by management should also be included. So that will include the installation costs and startup costs, necessary startup costs. And also, according to IS number 16, the initial estimate of the cost of dismantling and the removing the item and restoring the site on which it is located should also be included in the cost of the asset. So let's now compute for the cost of the asset. So the cost of the asset will include its invoice price or invoice cost. So the invoice price is 180,000. In addition to the invoice price, remember it is subject to cash discount. Although according to the problem, the company paid its liability to the seller within 10 days. So meaning the discount is taken or the company paid within the discount period. But regardless, taken or not taken, the 2% cash discount should be deducted. So the discount is 2% multiplied by the invoice price, and the invoice price is 180,000. So that will be 3,600. In addition to the invoice price and the cash discount, we also have the freight costs. Yan. So the freight cost is 2,000. Aside from the freight cost, we also have insurance during transportation. Insurance cost. This is 1,500. Aside from insurance, we also or the company incurred installation costs. cost amounting to 4,000 and also the necessary startup costs. So this is 500. Now for the dismantling cost, so we need to compute for the present value because the 30,000 cash outlay for the dismantling of the asset will happen after 3 years. So we need to compute for the present value. So this is 30,000 multiplied by 1.10 because the average borrowing rate is 10%. So this is raised to negative 3 because we are using present value formula. So I'm using 4 decimal place factor for the present value. So 1.10 raised to negative 3, this will give us 0.7513. So 0.7513 times 30,000. So the present value is 22,539. So let's add. So 180,000 minus 3,600 plus 2,000 plus 1,500 plus 4,000 plus 500 plus 22,539. So the total cost of our asset for financial accounting purposes is 206,939. So this amount will be subject to depreciation. Next requirement, prepare an amortization table for the dismantling cost. Actually, this is not necessary, but for illustration purposes, let's prepare an amortization table. So this is very similar to the amortization table for bonds, except the important columns are as follows. So we have, of course, the year, interest expense, or I told you from the previous slide, if you don't want to use the interest expense because this is not a liability, you can also use accretion expense and the carrying value. The carrying value of the dismantling cost, actually, the estimated liability for dismantling of the asset. So we have year 0, so meaning the year to date. So therefore, there is no interest expense. And the carrying value will be the present value of the dismantling cost. So that is 22,539. So after 12 months, so after 1 year, we need to compute for the interest expense. And that will be 22,000. So interest expense, this is 22,539 multiplied by 10%. So that will give us 2,253.90. So the effect of the amortization is that the carrying value of the dismantling cost will increase such that at the end of year 3, this 22,539 will be the 30,000 or the estimated cost of dismantling at day 0. So remember, this 22,539 is just the present value of the 30,000 estimated dismantling cost. So we need to add this interest expense to the carrying value. So 22,539 plus 2,253.90. So the carrying value of the liability at the end of year 1 is 24,792.9. Yan. So at year 2, we need to compute for the interest expense again. So the interest expense is computed as 24,792.90, the carrying value at the start, multiplied by the borrowing cost or the average borrowing cost, which is 10%. So that will give us 2,479.29. So we need to add again. So 24,792.90 plus 2,479.29. So that will give us 27,222.19. In year 3, we don't need to compute for the interest expense. Um, Remember, the goal is to make this carrying value equal to the estimated cost of dismantling cost. So this is automatically 30,000 at the end of year 3. So simply deduct 27,222.19 to the 30,000. So if we deduct 27,222.19 to the 30,000, so interest expense, this is 30,000 minus 27,222.19. That will give us 2,727.81. So, yan. Next requirement. So, the next requirement is the depreciation expense per year. So, this is per year, uh, meaning per year for 12 months. So remember, I told you before that as of your financial accounting and reporting, the only method you discuss is the straight line method. So let's apply what you have learned in your CA 5101. So the depreciation expense using straight line method is computed as yung cost of asset minus yung estimated salvage value or residual value divided by its useful life. So yung cost nung asset is 206,939. So salvage value not provided in the problem. So this is assumed to be 0. I-divide natin ng 3. So lalabas or the answer will be this is 68,979.67 per year. Ayan. Okay, what is our journal entry for year 1? So remember, for year 1, so we have a couple of journal entry. First, the acquisition of the asset. So that will happen at year 0 or day 0 or day 1. So meaning at the start. So there is no date given in the problem. So our first journal entry is to record the asset. So first, we debited equipment. So as we have computed before, this is 206,939. So remember, the liability was paid after 10 days, and this is day 1. So we still need to record a liability. So let's use the word payable to the seller. Ayan. So this is a liability. This is 176,400. So how did I compute for the 176,400? So this is 180,000 minus the cash discount of 3,600. Ayan. And next is the estimated dismantling cost. So estimated liability for dismantling of equipment. Okay, in the book used provision for equipment dismantling. So they are the same as long as both of them are liability. That will be the present value, so which is 22,539. Ayan. Now, my assumption is that for the freight cost, for the insurance, for the installation cost, and the startup cost, all of them was paid in cash. So, credit to cash for uh, that's 8,000. Ayan. So 176,400 plus 22,539 plus 8,000. This should be equal to 206,939. So after 10 days, we need to pay for our liability. So since this is paid within the discount period, our journal entry will be just debit to payable to the seller of the equipment. So this is liability. So this is liability minus because it was debited. Now this is 176,400 and credit to cash. This is 176,400. What if not paid within the discount period? If not paid within the discount period, so our entry will be debit to payable to the seller. So this is our liability. So this is 176,400. Our credit is cash. This is for 180,000. And the debit will also include uh, cash discount not taken or cash discount loss for 3,600. Okay, we're not yet done with year 1. So, although the second requirement is year 2 requirement. So, for year 1, we still need to record the uh, depreciation expense. So, that will happen at the end of the year. So remember, our depreciation expense is 68,979.67. So our entry will be debit to depreciation expense. So this is for the equipment. This is 68,979.67 and credit to accumulated depreciation equipment. This is 68,979.67. Aside from depreciation expense, if you remember, we prepare amortization table, so we need to uh, recognize interest expense related to the dismantling cost or acquisition expense in lieu of interest expense. So let's use interest expense. So debit to interest expense. This is 2,253.90. Please refer to the amortization table. And credit to estimated dismantling liability of equipment for 253 2253.90. So this is estimated discount liability. This is increase in liability. So at the end of the period or at the end of the year 1, the carrying value of the estimated dismantling liability will be 24,792.90, and it should be reported under non-current liability because it will be provided at the end of 3 years. So from year 1, at the end of year 1, we still have 2 years uh, to pay for the dismantling costs. For year 2, ayan, for at the end of year 2, so this will happen at the end of 12 months of year 2. So our journal entry will be the recognition of depreciation expense also. So depreciation expense equipment. So this, since this is a straight line, so this is still 68,979.67 and credit to accumulated depreciation. This is equipment. This is 68,979.67. Aside from depreciation expense, interest expense, but not anymore 2253.90. So our next interest expense from the amortization table is 2479.29 and credit to estimated dismantling liability for 2479.29. Okay, so for year 3, our journal entry will include again the recognition or the accrual of depreciation expense. So this will happen at the end of the year or after or in the 12 months. So our journal entries in straight line is depreciation expense. Depreciation expense, this is 68,979.67. Credit to accumulated depreciation equipment. This is 68,979.67. And just like from the previous years, so we also need to recognize interest expense. So debit to interest expense, please refer again to the amortization table. So that we the interest expense for year 3 is 2,727.81, and credit to estimated dismantling liability for equipment. So this is 2,727.81. Since if the company is not using the equipment anymore, so we need to dismantle the asset, the equipment, because that is our provisional liability. So in addition to the interest expense, assuming we dismantle the liability at the end of year 3, our journal entry will include debit to estimated dismantling liability. This is for 30,000, and credit cash. This is for 30,000. And in addition to that one, since based on our computation, there is no more future economic benefits, assuming we are not using the equipment anymore, so we need to derecognize the asset. So simply, in addition to this journal entry, dismantling costs, so we need to derecognize the equipment. Meaning derecognize is uh, we need to deduct the equipment in the list of our assets. So our journal entry is just to reverse the value of the assets. So as of the end of year 3, the value of the asset is equals to 206,939, and also the accumulated depreciation is equal to the cost, which is 206,939, because there is no salvage value. So our journal entry is debit to accumulated depreciation. So this is our equipment. This is for 206,939, and credit to equipment. This is 206,939. So the last journal entry is to derecognize the asset since we already dismantled the asset. So the entry to dismantle the asset is this one. So the debit to estimated liability, credit to cash. Thank you. So our next discussion is about the determining the purchase price or accounting for acquisition of assets at the initial recognition using different scenarios. Different scenarios like cash purchase, different payment of purchase price, installment plan, uh, exchange, for example, donation, exchange of equity securities, etc. In case you have problems or questions, or you need to clear something from my discussion, please let me know. Thank you.